Hey everyone, over the past few years, mutual funds have become highly popular among retail investors in India, and for good reasons. They are regulated, diversified, and easy to invest in through SIPs. But as more investors build meaningful portfolios, there is a growing interest in other options like PMS. PMS has been positioned as an investment category for the elite class with a minimum requirement of 50 lakh. Now, many small retail investors aspire to opt for PMS, but they do not have the required capital. So recently, SEBI has launched a new investment category called SIF, that is Specialized Investment Fund. This Specialized Investment Fund is positioned as PMS for retail investors who do not have minimum 50 lakh. You would need minimum 10 lakh rupee to invest in Specialized Investment Fund. Now on the surface, all three, mutual fund, PMS and SIFs are trying to do the same thing, help you grow your wealth through market-linked investments. But the way they are structured, the level of control you have, the cost involved and even the tax treatment, all of that is different. So in today's video, I'll help you understand what exactly is this Specialized Investment Fund, and more importantly, we'll discuss the core differences between these three models, mutual fund, PMS and SIF. And of course, the most important question, which one might be suitable for you based on your investment size, comfort with volatility and long-term goals. But before we proceed, one clarification, here we are talking specifically from equity investment perspective. So when I say mutual fund, I mean equity mutual fund, and SIF is also discussed in reference with equity category. Alright, let's get started. Let's first try to understand the difference between mutual funds and PMS. That will help you understand why there's a need for new investment category called SIF. So one of the key difference between PMS and mutual fund is, mutual funds have strict regulation to follow SEBI's classification rules. For example, a large cap equity mutual fund must invest minimum 80% in top 100 companies by market cap. And within that, maximum 10% cap for single stock. That is, mutual fund managers cannot invest more than 10% in a single stock irrespective of potential. Also, there is a cap of 25% on a single sector. Likewise, there are different categories like mid-cap, small-cap, multi-cap, flexi-cap. Then they all have various rules and mutual fund managers have to follow that. So flexibility is less in mutual funds. On the other side, PMS do not have such category restriction. Fund managers of PMS have full freedom to design any strategy. It could be concentrated bet, it could be multi-cap flexibility, and there's no stock or sector specific cap. Moreover, a PMS can put 30 to 40% on single stock if that is their strategy. So that's the first key difference. Second difference is mutual funds cannot invest in private equity or unlisted companies. PMS on the other hand can invest up to 25% in private equity, pre-IPOs, unlisted companies, giving high net worth individuals access to broader range of equity linked assets. Then third difference between mutual fund and PMS is, mutual fund typically have 50 to 80 stocks in the portfolio. Although there's an exception where there's a focused fund category with maximum of 30 stocks. However, typically there are 50 to 80 stocks in an equity mutual fund portfolio. But PMS take more concentrated bets with 15 to 20 stocks in the portfolio. Plus, as discussed in point 1, there's no cap on single stock or sector allocation. This can potentially help them generate higher return as compared to mutual funds. But due to these regulations, PMS become a higher risk and higher reward category, more suitable for high net worth individuals. Hence, there's a restriction where you need a minimum of 50 lakh of investment in a PMS fund. On the other side, you can start with as low as 500 to 1000 rupee with mutual funds. In fact, some mutual funds are now offering 100 rupee SIP. Apart from this, if you look at the fee structure, mutual funds have expense ratio that varies from category to category, but typically in the range of 0.5 to 1.5% for direct funds. PMS also have similar fixed fee model, but some PMS also offer profit sharing model with a fixed base fee plus performance fee that could be, let's say, 10 to 20% of profits. Last key difference between mutual fund and PMS I want to highlight is, in equity mutual funds, investors do not hold individual stocks in a demat account. Instead, they own units of the fund and the fund itself holds the stocks. PMS provide direct ownership of stocks. A demat account is opened in the investor's name and linked to the PMS provider for management. The PMS provider or portfolio manager act as a custodian or manager executing trades and managing the portfolio. So unlike equity mutual funds where investors see only the fund's overall holding and NAV, that is net asset value, PMS offer higher transparency as investors can see every stock in their portfolio and its individual contribution to returns. So what SEBI is trying is, they're trying to bridge this gap between mutual fund and PMS by introducing SIF, that is Specialized Investment Fund. Please do not confuse SIF with SIP. SIF is a category like mutual fund, whereas SIP is systematic investment planning, which is an investment strategy within mutual funds where you invest systematically. Now, how is SIF different from mutual funds? Well, it is quite new, so we need more clarity. But as of today, based on available information, one of the key difference between mutual fund and SIF is, unlike mutual fund where investors own units of the fund instead of individual stocks, in SIF, investors will directly hold the stock in the demat form, similar to PMS. And a fund manager would act as a custodian or manager executing trades and managing the portfolio. Second difference is on concentration, where unlike your mutual funds that have 50-60 stocks, SIF can be highly concentrated, similar to PMS. Third key difference is mutual fund cannot invest in unlisted market and private equity market, but SIF can invest in private equity, unlisted market, similar to PMS. It gives more flexibility to explore market beyond the listed space. Although SEBI's final circular is awaited on the exact limit for unlisted and PE investment allowed for SIF, I assume it would be similar to PMS, that is around 25% maximum exposure. Then fourth difference is, unlike mutual funds, SIF is allowed to take up to 25% of its NAV in short positions through derivatives. A short position means you are betting that the price of a stock or index will fall and you aim to profit from that fall. This short selling is not allowed in mutual funds, but now it is allowed in SIF, where fund manager can benefit from fall in stocks by shorting it. So this is again a key difference between SIF and mutual funds. But you would need to invest minimum 10 lakh rupee in SIF, whereas in mutual fund you can invest as low as 500 rupee. The reason is SIF has relatively higher risk due to various flexibility to generate high return, and that's where SIF is designed for someone who has a decent investment corpus of at least 10 lakh rupee and above, but does not have 50 lakh for a PMS. I hope you got a fair idea on key difference between mutual fund and PMS and your mutual fund and SIF. Now the next question is it worth investing in SIF? If yes, who should invest? So first of all, this is a new category and at the moment I have not come across any SIF. Although I have read that some fund houses have filed for SIF product with SEBI. Second, we always had PMS, but it does not mean that PMS have outperformed mutual funds by a huge margin. Sure, some PMS would have outperformed mutual funds, but broadly speaking, as per my knowledge, the median return of PMS is lower than median return of mutual funds. This one image I found on Twitter that has compared the mutual fund versus PMS median return over 1 year, 3 year and 5 year that suggests mutual funds have done better than PMS. There are a couple of reasons why median PMS returns struggle to outperform mutual funds. First is, PMS generally has higher cost structure, so that actually reduces the overall return. Second key reason why PMS struggle to outperform mutual fund is due to taxation. This is very important and one of the key difference between mutual fund and PMS. So within mutual funds, when fund manager make any change in the portfolio, that is buy or sell any stock, there is no tax on that. It means, let's say you hold mutual fund for 3 years and during that period, fund manager buy sell 100 stocks. But there's no tax on that until you redeem your units, that is until you sell your mutual fund. However, in case of PMS, every time the PMS manager sell a stock, there's a tax they have to pay. So if the stock is sold within 1 year, there's 15% tax on profit. After 1 year, there's 10% tax. This taxation is one big factor that eat a lot of profit of PMS and they struggle to outperform the mutual funds. The good part is, in SIF, taxation would be similar to mutual funds. So it would be best of both worlds, that is mutual funds and PMS. Overall, in my opinion, mutual funds are still great for a retail investor in India. PMS for me is just a glorified mutual fund for elite class who want to get the differentiated feeling. You know that feeling, mutual funds are for everyone, PMS is not for everyone. Also, sometimes there is a peer pressure where you see your HNI friends investing in PMS and you also want to be part of that group. Again, nothing against PMS. if you have lots of money with risk-taking appetite, and if you can find a really good PMS, you can go for it. But the challenge here is to identify really good PMS out of the crowd of hundreds of PMS. It's not an easy task. Now, as far as SIF is concerned, it certainly looks interesting, especially due to very flexible regulation. Plus, their ability to invest in private equity and unlisted space, along with the ability to short sell. But will they outperform mutual funds? Difficult to call out at the moment. In any case, it's worth tracking this category closely. I'm sure in the coming months and quarters, when fund houses launch SIF, there will be a lot of buzz around it. And those who felt left out from PMS due to inability to invest 50 lakh might get tempted to invest in SIF with minimum limit of 10 lakh. But before investing your money, make sure that you clearly understand the risk and reward structure of the product and whether it suits your risk appetite and financial goals or not. So this is it for the video. I hope you'll find it useful. If yes, do share it within your circle. I'll see you next video. Till then, take care.